Hello everyone, I am Dr. Kuldeep Baishya, Assistant Professor at School of Business, Indian Institute of Technology, Guwahati. I welcome you to the first session of this course, Metrics and Analytics of Marketing. In today's session, we will try to explore the foundation of metrics, what is it all about, why metrics are important, and how these metrics can be applied for informed and better business decision making process. We will also try to understand what is the difference between marketing metrics and marketing analytics from a practical standpoint. And towards this end of this session, we will try to understand what are the different obstacles in implementing data driven or metric driven marketing and how to overcome those obstacles. Let us start this session with a very basic but inquisitive question. What is metric? Is it a product? Is it a purpose? Is it a phenomenon? Or is it just a portrayal? The answer is none of this. Basically, metrics refer to measurement. Metrics refer to quantification. From a business standpoint, metrics is all about measuring an organization's activities and performance. It tries to map the activities to the performances. So, when there is an established mapping between an activity and a performance, then if there is any problem in the business dynamics, if there is any problem with the performance, we can fine tune the associated activity. Unless and until that mapping is there in place, even if there is a problem in the business dynamics, we will not be able to diagnose or we will not be able to take corrective action on that problem. A marketing metrics can be related to customers, it can be related to employees, or it can be related to the business as a whole. For instance, if we talk about customer churn, it is a metric related to customer. We can also talk about customer's lifetime value, which is a metric related to customer. So, let us say if there is a report which says that customer's lifetime value is improving, then there are lot of implications. There are lot of possibilities that we need to understand in order to improve our business. So, what is customer's lifetime value? So, it can be derived from three dimensions. First one is that customer's transaction value or transaction value of an average customer is increasing. Second one can be frequencies at which the customers are buying is increasing. Or third one can be the loyalty duration of an average customer for my brand is increasing. So, if any either of this aspect is improved while remaining two aspect remains the constant, then our customer's lifetime value will increase. Anyways, we will discuss about customer's lifetime value in terms of how it can be quantified in detail in the subsequent classes. But what is the purpose of understanding customer metrics is that when there is a report which says customer lifetime value is either improving or it is getting deteriorated, there are multiple critical business dynamics that needs to be looked into. Similarly, the metrics can be for employees. So, employee turnover, if more number of employees are leaving the organization, probably there is something wrong with the organization. So, we need to take the corrective actions. So, we need to understand the metric called employee turnover. Next, for example, you need to measure the performance of an employee. Let us say the employee belongs to the sales domain. So, how the performance of a salesperson can be evaluated? In terms of certain key performance indicators. So, one of the possible key performance indicators can be sales target. So, whether the employee has been able to meet the sales target for the financial year or not. he might be meeting 120% of his sales target, he might be meeting just 80% of his sales target. So, there will be a weightage associated with the sales target. So, we need to understand that sales target is not the only activity that a salesperson perform in its while disposing his responsibilities. So, what are the other activities? For example, how many new accounts are being created? So, this can also be a activity related to a salesperson. It may not directly relate to the revenue generation for that particular financial year, but if a new account is generated, there is a possibility that over a period of time, the new customers will keep engaging with the organization in a more frequent way and probably create more value for the organization. So, that is why whenever we are evaluating the performance of a salesperson, both activities, selling activities as well as non-selling activities needs to be taken into consideration. The weightage given to selling activity may be different from non-selling activity. So, through a research or through proper analysis, the weightage can be distributed across the dimensions. But it is important to understand each of these metrics associated with an employee. Then the metrics can be related to the business as a whole. For example, what is the market share? What is the increase in market share from the last financial year? So, what does it imply? Let us say our market share is increasing by 5% as compared to last year, then it says that we are performing better as compared to our competitors. We need to understand that increase in sales does not really mean that there can be an increase in market share. So, there can be an increase in overall demand in the market, that is why your overall unit sold is increasing, but your market share is not changing. So, the implications that we can derive from these two different phenomena will be different. In one case, we can say that we are performing probably better than our competitors, and that is why our market share is increasing. And in other phenomenon, we can say that our increase, there is an increase of demand of our product, because in the overall market there is a increase in demand for that product. So, these two implications are different. Then there can be this one another matrix related to a organization as a whole, which can be, let us say, return on investment, return on asset. So, we will discuss about all these metrics individually at a later stages, but let us try to understand why these metrics are important. So, now let us move to the formal definition of metrics. So, a metric is a measuring system that quantifies a trend, a dynamic or characteristics. It can quantify a trend, it can quantify a business dynamic, it can quantify or it can describe the business characteristics. So, practitioners use metrics to explain a phenomenon, they use it to diagnose different causes associated with different performance or outcome. Practitioners use the metric to share the findings and to project the results of the future events. So, throughout the world of science, business and government, metrics encourage rigor and objectivity. So, metrics basically refers to a detailed holistic understanding of the entire phenomenon, and it encourages objectivity over subjectivity or subject to interpretation. So, they make it possible to compare the observations across different regions, let us say in a cross sectional analysis, or across different time period, let us say a longitudinal analysis. So, thus with the help of this quantification, metrics facilitate understanding and better collaboration. Now, what aspect is done? What is metric we have understood? It is all about measurement of a dynamics. It is all about measurement of a phenomenon. It is all about mapping the performances to the activities. Now, let us try to understand why do we need metrics. So, before understanding that, before pinpointing why do we need the metrics, let us try to reflect back on the statement given by John Bartlett. He said, when you can measure what you are speaking about and express it in numbers, you know something about it. But when you cannot measure it, when you cannot express it in numbers, your knowledge is of a meager and unsatisfactory kind. It may be the beginning of the knowledge, but you have scarcely in your thoughts advanced to the stage of science. What is he emphasizing on is that whatever you are speaking, that should be backed by quantification, that should be backed by numbers, that should be backed by data. Otherwise, probably you are speaking something which you also do not understand accurately. We need metrics to take informed decision making, to take informed decision. Metrics helps extensively in informed decision making process. If we have data in place, if we have the defined variable in place, then in that case it is easier for us to understand these variables and relate these variables to the antecedents. Let us say my market share is decreasing. So, I have to find out which particular variable is resulting in decrease in market share. So, I can find out the antecedent. Let us say the decrease in advertisement expenditure is resulting in a decrease in market share. So, what corrective action do I have to take? Probably I have to increase my budget for promotional activity. This is what is informed decision making. Metrics is important for performance measurement. Let us say we are measuring the performance of an employee at the end of the year. There will be some defined KPIs. So, what are these KPIs? These KPIs are nothing but metrics. Sales target is a metric. New account generated is nothing but a metric. Expense incurred per unit sale, your evaluation can be analyzed from that aspect as well. So, that is also nothing but a matrix. So, matrix helps us in evaluating the performance of the employees or performance of the company as a whole in a holistic and exhaustive manner. Matrix is important for ROI calculation. In fact, ROI itself is a metric. What is ROI? Return on investment. Let us say you are investing 1 crore rupees for a business, and at the end of the year you are deriving a net profit of 20 lakhs. So, what is the ROI? It is 20%. ROI is nothing but a matrix. So, you need to, otherwise your investment will be meaningless unless and until you understand that you have created value from that investment. The value is coming in terms of the profit. Matrix also helps us optimize the resource allocation. What is optimization? Optimization is nothing but maximizing or minimizing an objective function under certain set of constraints by sending certain set of decision variables. In a business perspective, most of the time the objective function is maximizing the profitability. The constraint may come in terms of asset, the constraint may come in terms of budget, the constraint may come in terms of time frame, and the decision variables can be, let us say, investment in marketing, investment in research and development, investment in automation. We can optimize different resources by looking at matrix. Let us take an instance. Let us say we can see that a particular product line, the marginal increase in revenue due to increase in expenditure in marketing activities is very meager for product line 1. But for product line 2, the incremental increase in revenue due to unit increase in marketing budget is very high. Then in that case, what we can do in order to optimize the overall revenue of the brand or organization, we can shift the marketing budget from product line 1 to product line 2. So, that is what is optimization of the resources. Last one is that metrics help us in continuous improvement of the business process. Because of the existence of the metrics, we understand the cause and effect relationship among different variables. We understand which variable is underperforming. Let us say market share is underperforming, market share is decreasing. We need to find out what is the reason. Once we find out the reason that market share is decreasing because of decrease in budget in marketing activities, now it is time for us to increase the budget in marketing activities. So, these are the reasons why we need a metric. Next, let us try to understand the distinction between these two terms, metrics and analytics. Remember that these two terms are related to each other, but they are distinct in nature. So, metrics, which is also known as the key performance indicators, are the standard used to measure the performance or success of your marketing programs. On the other hand, analytics involves leveraging metrics to uncover trends and insights that guide decision making in your marketing strategies. In simple terms, metrics is all about understanding the what aspect, and analytics is all about understanding the why aspect and taking corrective actions based on the why aspect. From metrics, we understand that market share is decreasing. From analytics, we understand that market share is decreasing because of decrease in expenditure in marketing budget. From analytics, we have to take a corrective actions, or we have to recommend that we need to increase the budget in marketing or promotional activities in order to keep our market share intact. So, this is the basic difference between metrics and analytics. Let us now try to understand the meaning of marketing metrics in a formal way. As we say, metrics is related to measurement, metrics is related to data. Marketing metrics or metrics driven marketing refers to the strategic approach of applying precise and measurable metrics across all aspects of marketing activities. This may include product related activities, this may include price related activities, this may include distribution related activities, this may include promotion related activities. Next, the primary objective is to enhance the ability to forecast the return on marketing investment. So, when we talk about the marketing metrics, it is all about, in business perspective, we talk about the return on investment. When we talk about the marketing activities, it is return on marketing investment. So, we will look into how much additional investment we are making in marketing activities and what is the incremental revenue or what is the incremental profit that we are deriving that can be attributed to the incremental increase in marketing activities. So, thereby achieving more effective and impactful marketing outcomes. Whether digital marketing yields you better outcome or the traditional marketing yields you better outcome can be analyzed, because we have metrics in place. We have the digital marketing metrics in place, we have the traditional marketing metrics in place. Marketing metrics, when we talk about marketing metrics, it spans across spectrum from easily measurable direct response marketing to more complex evaluation of the brand awareness advertising. Some of the metrics related to marketing are very simple to calculate. Example, market share. What is the share your brand or your organization sells in the overall market? But there are some complex metrics as well. For example, customer preference or customer willingness to pay. How do I measure that? It cannot be directly observed. It has to be, this is a more like a lethal construct. It is more like a perceptual construct. How do I measure customers' willingness? So, probably there will be a scale in place probably there will be a questionnaire in place through which we will be able to understand how much the customer is willing to pay for a particular product. So, this is a perceptual construct and it is prone to measurement error. It cannot be directly measured, it cannot be directly observed. So, this becomes a complex marketing matrix. So, now as we have understood what is matrix, why is matrix important, what is matrix and how is it related and different from analytics. Now, let us try to understand a practical phenomenon in business environment. There are 5 obstacles to data driven marketing or metric driven marketing, and we will try to understand what are these obstacles and how can we overcome these obstacles one by one. The first obstacle is getting started. How do I start with data driven marketing or how do I start with metric driven marketing? I do not have any clue. So, we do not know how, we do not have the right metrics in place, we do not know what to measure, how to measure. At the max we only know I have investment this month, I only know about the return on investment. I do not know how to measure the different initiatives. How much of the investment in marketing budget has resulted in incremental increase in revenue, that I cannot attribute. So, this is a problem because I do not understand the metric properly, that is why I do not understand this cause effect phenomenon. I do not understand this attribution problem. The problem is not too little data most of the time, quite the opposite, we have the lots of data, but none of the data are useful. We are not probably collecting the right data, we are not converting the data into meaningful information, we are not understanding the relevant variables, and that is why it is difficult for me to get started with the metric driven marketing. So, how to overcome this problem? First thing that we have to do is focus on collecting the right set of data, identify the problem, identify the relevant variables, identify the possible cause effect variables, and then start collecting the data. Then only you can somehow get started, and you have to create a momentum by scoring an easy win. Let us check the second problem, second obstacle, causality. So, it is extremely difficult to understand the cause and effect phenomenon, especially in business dynamics, because it is dynamic in nature, nothing is staying constant in business dynamics. So, there are too many confounding factors, overlapping campaigns make defining cause and effect impossible. Let us say simultaneously I am running 2 campaigns, one is the digital campaign and another one is the traditional broadcasting, and I find that there is a 20% increase in our revenue. So, now what is the percentage that I attribute to digital campaign and what is the percentage I attribute to the traditional campaign or traditional broadcasting? So, this bifurcation becomes extremely challenging. It becomes more challenging, it becomes more extensive the moment it is not related to 2 campaigns run by the company, rather it is related to the macroeconomic environment. The revenue is increasing because there is a cut on GST. So, how much should be attributed to cut in GST and how much should be attributed to our digital campaign? It becomes challenging. So, this causality is very challenging when it comes to business environment. Another aspect is that there is a time delay between the marketing campaign and customer action. I start a marketing campaign, people will first become aware about my brand or product. AIDA framework, it will go through AIDA stages, awareness, then they will generate some interest on my product, then they will have a desire to buy my product and ultimately they will purchase the product. So, it gets through certain stages and these stages, each of these stages will consume its own time. So, there is a clear lag period between my investment and my result. So, awareness campaign do not directly result in sales, but our chief financial officer wants to see the financial ROI. I have investment this much money in this campaign, what is the outcome in the last financial year? Reality, what might have happened that in the last financial year, there is no incremental increase in sales because of this campaign, but it has created more awareness and people are developing interest for our product, and in the subsequent years, though the investment is related to this year, the sales can be realized in the subsequent years. So, that is one of the problem of causality. So, how to overcome this problem of causality? So, simply we can conduct small experiments. Let us say we create a simulated environment and then try to find out what is the lag period, or if we control for one variable, what is the impact of other variable, and then we can extend this coefficients in such a way that we can properly attribute the performance to the right activity. Example can be, let us say there is a digital marketing campaign in place and there is a traditional marketing campaign in place. So, in a simulative environment, we will not run these two activities simultaneously, rather we will run one activity at a time. So, what is the incremental value one activity is creating? Which one is creating more incremental value? Now, the moment we understand that our digital campaign in isolation is creating more value as compared to our traditional campaign, so many things are clear now. And through this iterative process, probably we will be able to precisely allocate the performance by the this one digital campaign and the performance by the traditional campaign. So, we can also use the marketing mix modeling, product, price, place and promotion. So, at a time we will control for other variables and we will emphasize our observation only on one variable, whether revenue has increased because of improvement in the product or because of decrease in the price. So, to understand that, to understand what is the extent to which the revenue, there is an increase in revenue due to product improvement, then we have to keep the price constant. Once we understand the extent for each of this individual initiative, then it is easier for us to attribute the performance to the activities. We can also use certain econometrics models such as time series analysis or attribution modeling. So, the challenge of causality can be improved or can be overcome with the help of data, with the help of statistical analysis. Sometimes the obstacle is due to lack of data. We do not have the required data in place. It is just opposite to our first obstacle, where we did not understand the data, but we had abundance of data. Now, in this case, there is a possibility that there is not enough data. Let us say we are a business to business company and sell indirectly. So, as a result, we do not know who our customers are. We can collect the customers data due to privacy issues. Now, if there is a decrease in demand, it will be extremely difficult for us to understand why there is a decrease in demand, because we do not have a direct contact with our customers. So, how can we overcome this kind of a obstacle? So, we can do channel partner data sharing. We will ask our channel partner to give us the feedback from our customers, though we are not in direct touch with the customers. So, probably the retailers will have they will hear a lot of complaints about our product. They might hear a lot of complaints about the price, increase in price, and if that information can be propagated to us, then in that case we will be able to take the corrective action. Or we can also use the surveys as a proxy for customers' data. So, we must have a better understanding about the customers' needs, requirements and their evolving needs and requirements over a period of time. So, through these instruments we can overcome the obstacle of lack of data. Next obstacle is resources and tools. So, we do not have the time and it costs too much. Sometimes we do not have time for data driven marketing, because another aspect can be it is too costly. Probably I have to hire an analyst or I have to outsource the analysis to an external company, which will cost me money. There is a possibility that we do not have the tools or system to support the data driven marketing. We do not have the softwares in place in order to analyze the data, or in order to analyze implement the recommendations. The thought process might go that we are marketers and can communicate with the information technology people. I am a marketer, I am creative, I value more, I value myself on creativity rather than data. So, why would I communicate with the IT team? So, there may be reluctance from my side. So, information technology team, they build system, but they are not the resources and tools we need. So, that is why there can be a difference of understanding between the marketing team and the information technology team. So, how can we overcome this obstacle of resources and tools? First thing that we can do is build the infrastructure for data driven marketing, proper infrastructure, the required softwares, the required analytical tools are there in place. Then next one is that there has to be a established relationship between the marketing team and the IT team. They should be complementary to each other, they should respect each other, then only we as a organization will be able to come up with a data driven or metric driven marketing strategy. The last obstacle, but not the least, is the people and change. So, people are basically reluctant to change. So, marketing was in earlier days, marketing was more of a creative and subjective activity. It could not be objectified. So, it was based on my gut feeling about the customer needs and requirements, not backed by data. So, we do not measure because we do not want the accountability. The moment it is objectified, the moment I am being evaluated based on the sales target that I am achieving, I have an accountability. I have an accountability of my performance. Though I am slogging in the office for 8 hours a day, my performance is, objective performance is not as per expectation. So, it becomes accountable. Our incentives are all for marketing activity, not results. We have a feeling like that. The traditional people, they might have a feeling that I am going to the office every day, I am not taking a single holiday, still I am not getting the appraisal, required appraisal, because my performance is evaluated based on objective criteria. We do not have a culture of measurement. We do not want to measure our performances because of this accountability. We do not have the skills for data driven marketing. Sometimes we do not have the required skill for data driven marketing. We do not have that analytical thinking process in place. In some cases, organization is resistant to new ideas such as data driven marketing. And another important problem is marketing is perceived as just a creative activity by many. It imposes metrics and processes will kill creativity and innovation. So, there is a feeling that if we put metrics in marketing activities, then it will kill the creativity, it will kill the innovation, because people will be more inclined towards working as per their KPIs. So, how can we overcome this obstacle of people and change? So, first thing that we have to do is create a data driven marketing culture, create incentive for change, measurement and behavior. So, give them incentive for adopting to the new practice, and ultimately we can overcome the data driven marketing skills gap. So, data driven marketing in an organization might not be happening because there is a skill gap. People working in the organization are not skilled enough to adopt data driven or metric driven marketing. So, once they are being upskilled, then they will be ready to adopt metric driven marketing. So, this is all about today's session. So, I will see you in the next session with a different topic. Thank you.